You are listening to WTUZ Radio Podcast. Welcome to WTUZ Radio Podcast. I'm Rhonda. And let's get into the update that, or the announcement rather, that the Fed Reserve Jerome Powell made with raising interest rates again. Okay, so he issued a formal statement, and we knew this was coming. We talked about that end of last year, beginning of January. I told you that interest rates were going to rise. I told you why they were going to have to rise. It was definitely because of inflation. Okay, so now we should all know inflation, because we're all experiencing it from the grocery store, also the gas prices. So pretty much anything that you're trying to buy, if you've purchased that same item before a couple of years ago, you know that you are paying more for it. Okay. All right. So that's across the board. Okay. So we discussed why that was happening, and it's all because of the free money, which is really never free, that the government was giving out. So those PPP grants and loans, the extended unemployment, the stimulus checks, and raising the debt ceiling. Remember those times when they threatened where the government was going to have to shut down if the Congress or whatever didn't vote on raising the debt ceiling? What they're talking about when they talk about raising the debt ceiling is permission to borrow more money or fiat currency from the Federal Reserve, which isn't quote, quote, governmental at all, which is a private institution, a private banking cartel / institution. Okay. So all of that talk, when they talk about raising the debt ceiling, is basically to go back and borrow more money from the bookie, which is the Federal Reserve, which the Fed Reserve sets the points on the money borrowed, i.e. the interest rates. So what causes inflation again is the passing out of a bunch of money that folks want to label as free, when it's never free. That's one layer of the story. The second layer of the story is when the bookie, the Fed Reserves, set the interest rates or them points low. It is quote, quote, cheaper to borrow money. Okay. So that's what caused the housing boom. And now we are entering in a housing bust because we are at a housing bubble. So that's what caused the housing boom, because interest rates were so low. I think you could at one time get a home loan at 3-4%. Okay. So everybody was rushing out to go get homes. The sad part about it is first-time homeowners literally got priced out because the demand for folks going out buying homes, because of the cheap interest rates or the low points on borrowing the money, drove up demand. Okay. which essentially made the housing prices go up even further. And you can tell it was greed across the board, and how you could tell you're going into a bubble when everybody and their brother and cousin overnight become investors in this and that. Okay, and real estate was no different. We saw the same behavior in the 2007, 2008 crash. And why folks think they can do the same thing and expect different results is beyond me. But that's exactly what's happening again in the housing market. So you have those group of investors going out buying blocks and blocks of homes. Okay. Ultimately pricing out first-time homeowners. And then the second group, and either they're turning those into Airbnbs or they're renting them out. And then the second group are just, running the mill Joe schmoes. Now they're real estate investors going out buying multiple properties, turning them into Airbnbs. Okay. That's what drove up the housing market, drove up housing prices, and essentially priced out first-time home buyers. Okay, so what we have now in this particular bubble is a bunch of investors and folks that did buy homes, those overpriced, overvalued homes, where they were overbidding each other, buying stuff without inspections, bidding on houses $100K over the asking price just to get the home. What do you think's going to happen as the bubble starts to pop? They're going to be upside down. So meaning they're going to owe more on that home than it is worth. Okay, same thing that happened in 2008. And if they did not get a fixed interest rate, so meaning if they didn't lock in at a fixed rate, interest rate that would never change, if they had an adjustable rate, because some people would do that, get an adjustable rate. And the reason they would do that is because they wanted a lower mortgage payment, because adjustable rates are usually lower. And in those cases, not all of them, but some of them, they really couldn't afford the house to begin with. As those adjustable rates start to kick in, go higher, or they have balloon payments, they're unable to pay, and then they start to default. Okay. So all we have to do is watch the real estate market and watch defaults and ultimately foreclosures to see the change in the housing market. You can also watch how long houses are staying on the market, and you also watch price reductions. Okay. So it isn't happening in large numbers right now, but you are seeing some areas where it is definitely showing that the bubble is bursting. Okay, so particularly out west, couple states out west, it's happening, as well as Florida, and those were some of the same states where the early warnings of a housing crash in 2007 and 2008 happened as well. Okay. But make no mistake about it, just like 2007, 2008, financial crises was based on cheap money and interest rates. This is the same thing we're facing today, except this time, on top of that, We also had in the mix supply chain issues. Okay. So the total supply chain of goods and services being moved from the ports to the stores has been all jacked up since the pandemic. Okay, so that's also coming into play this time. So, because of the supply chain issues, that's also causing supply shortages, which also drove up the prices, right? Then you throw in there the Ukraine stuff and the oil, and the Russia stuff and the oil that blew up the gas prices. All right. So inflation across the board. Okay. So let's get into this press release. This is from the Federal Reserve's official website. Recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Russia's war against Ukraine is causing tremendous human and economic hardship. The war and related events are creating additional upward pressure on inflation and are weighing on global economic activities. Okay, so I want y'all to peep game when they're talking about global economic activities. The committee is highly attentive to inflation risk. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 2.25% and 2.5% and anticipate that ongoing increasing in the target range will be appropriate. Okay, so I just want to clear up for you, fam, because if you're thinking, 2.5, 2.25, 2.25, that's not bad. You have to take into consideration that's not the rate that you're going to get as a consumer. Okay? That's not the rate you're getting. You have to triple the rate that you'll borrow. Okay, this rate is between government to government and banks to banks. Okay, so just to be clear. All right, so let me just make sure he's saying. Okay, so all right, let's see. So yeah, I'm assuming that that's 2% now for them. But let's just continue. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, as described in the plans for reducing the size of the Federal Reserve balance sheet that were issued in May. The committee is strongly committed to returning inflation to its 2% objectives. So let's just be clear what they're talking about when they talk about reducing agency debt and the mortgage-backed securities. Because what that basically means, so addition to the Fed being the bookie, the Fed would also buy up debt. Okay? So Treasury debt, that should be pretty self-explanatory. That governmental debt, U.S. Treasury debt, okay, and mortgage-backed securities. So, meaning, I I know some of this may be redundant for some of you, but just hang in there, bear with me. Okay, because I'm going over this so you can always understand what they're talking about in the news when they're making these announcements. Because unfortunately, they're not going to go into the explanations for you. They're just going to make these announcements, and it's going to sound like wah, 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 wah with the details. And all you're going to hear is the Fed's going up on interest rates. Okay? So when they talk about mortgage-backed securities, they're really talking about, here's how it works. So you go in, you get a mortgage, okay? And let's say I go in, I get a mortgage. And let's say 10 other people go in and get mortgages. What happens is all of our mortgages, so that's 12, all 12 of our mortgages, and I'm sure they package more than that. I don't know the amount of mortgages they group together. All of our mortgages are combined and packaged together and sold on Wall Street as securities. That's what a mortgage-backed security is. Okay? And so the Fed was also buying those particular securities as well. Okay? Now, some say, and I'm tending to agree with them, that with the Fed buying up all of that debt, they were making the United States corporation look much better than it is on paper. Okay? When in fact, the United States government, well, it's been bankrupt technically since 1933. But okay, so even they're pretending that they have been doing since 1933. They didn't bankrupted the pretendency, y'all. I mean, how much more broke can you be? But that's basically what they have been doing. Okay? They get themselves in a bind from spending like drunken sailors. They call on Big Daddy to get some money. But you got to pay Big Daddy back. He don't know you like that. I ain't in that type of relationship where you ain't got to pay back. You got to pay back. You got to pay back on them points. Okay? So Wall Street and them doing the same thing. So in addition to that, these mortgage-backed securities, you have insurance companies that were insuring these mortgage-backed securities. So that example of the 12 mortgages I gave that were packaged up and sold on Wall Street as a security investment, it is given a score by Moody's and them, the financial them people, saying, okay, based on everybody's credit history in that particular mortgage-backed security, all 12 of them, we score this at a B. Okay, so it's a pretty, it's not a risky investment. Okay, so when they're selling these mortgage-backed securities on Wall Street, it has to have a grade on it. Okay, so the as bad as the grade gets, the more risky it is. As good as the grade is, so like a credit A is, of course, a good, a low financial risk is what I'm trying to say. Okay, so you got everybody playing casino, because at the end of the day, that's what they're doing. They're playing casino, calling it finance, but it's casino money. And the house always wins. Isn't that the rule of casinos? That's why I don't mess around today, y'all. I'm cheap. You just gonna get $100 up out of me. And I'm finna spread that little $100 around at them little different areas. And that's all you finna receive out of me. Because the house always wins. And in this case, the house is the Federal Reserve. Remember, the Federal Reserve is not federal government. It is a private institution. It is the boss of all bosses of banking. So the Federal Reserve is the boss of all boss of banking. But that boss rolls up to the International Banking Settlement and the IMF, the International Monetary Fund, who rolls up to Granddaddy, which is the Vatican. Okay? All right, so I want us to be clear when they're talking about reducing holdings. So they like, Big Daddy, Big Banking Daddy, like, no, I'm not getting ready to buy y'all debt no more. That's basically what he's saying. Okay, so, and he pretty much says this here as they're planning to reduce the size of the Federal Reserve's balance sheet. Okay, and yeah, they did say that in May in their little defense. So none of what they're doing, let's be clear, none of what they're doing, they're not hiding it. They give disclosure. It's just 90% of the population don't care or can't comprehend. Okay. The other 10%, they do get all of what I've described. Well, I'm going to say, let's get that down to 9%. They do get all what I've described. The 1%, y'all know who you are. You even know the back end of how all of this really works. Because at the end of the day, it ain't about the money. We've gone over this several times. It's not really about the money. It is about the land asset and the people asset and your labor. Because the people's energy will always be much more valuable than their currency. Okay? All right. So anyway, Big Daddy said he not buying no more the debt. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. They already know what the economic outlook is, okay? We literally called this last year when Big Daddy Chairman Jerome Powell issued the statement that he may have to raise interest rates if things don't change. And I told y'all, because he said that about 3-4 times. Every time he mentioned that he may have to do it. And I told you, it ain't if, it's just when. Okay? They already know what the economic outlook is. You know how they know? Because they created that outlook. They created it. They understand the psychology of folk. They understand that all they had to do was create the right conditions, i.e., the illusion of free money, the illusion of cheap money, and they knew that the government, i.e., the corporation, who's making decisions on behalf of the people, would spend like drunken sailors, and they knew that the average U.S. consumer would also spend like drunken sailors. So they're always going to know what the economic outlook is because they're creating the conditions. Okay? And people give their consent to this system all the time. Okay? So it's not like they're lying to you. The only thing they're really hiding from you is that 1% of information regarding public and private. But all of this other stuff, which really should be enough for the 90% to wake up and say, this ain't nothing but a casino, this ain't nothing but a racket. All right, but let's continue. The committee would be prepared to adjust the stance of the monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures, and inflation expectations, and financial and international development. Okay, so they're giving you all who voted on all of that. You know, that's Big Daddy, Jerome Powell, and the rest of the board. Okay, so again, it's not like they're hiding what they are doing. So, and let's just be clear, this is just not in the U.S. All right. I think last week we did something on Sri Lanka with that government collapsing. And shout out to Brother Odell on Thursday. He told us about protests going on in Italy, protests going on in Paris. Okay, and I think Australia can be added to the list also. And I know people in Australia have been complaining about their housing prices. They have a massive housing bubble as well. Okay, so this is really a worldwide issue. It did not just wake up overnight and happen. It is not something that they did not know about. Again, they created the conditions for these things to happen. Okay, because we are in the midst of a major reset on every level, on a social level, on an economic level, and more importantly, on a spiritual level. Okay? So this just represents the financial reset of the house. Okay? All right, and shout out to Nisi Poo. She sent me something earlier this week where these gentlemen were pretty much summarizing what we've been talking about over the past couple years, saying how the economy is kind of imploding, and how ultimately it's just they're gonna come back and stand up cryptocurrency, which we already talked about that. And the difference is cryptocurrency is very much trackable and controllable. And they also talked about universal basic income. That's going to be rolled out, which we've talked about that as well. Okay, so I was very happy to see other content creators start to talk about those things as well. Okay. All right, so the other thing I just wanted to real quick, this is off of CNN Business, what the Fed rate hike means for you. Okay, so CNN, don't play no ads, baby. I know you probably will. Let's see what they have to say.
I invest in Invesco QQQ, a fund that gives me access to NASDAQ 100 innovations like CGI. Oh. Don't worry.
Become an agent of innovation with Invesco QQQ. Before investing, carefully read and consider fund investment objectives, risks, charges, and expenses, and more in the prospectus at Invesco.com.
Higher interest rates, the biggest rate increase in decades. It'll make it more expensive for families and businesses to borrow money. After years of cheap money, your debt is becoming more expensive now. Higher rates for mortgages, credit cards, car loans, student debt, and business loans will cost more. The effect already dramatic in mortgages. The 30-year fixed-rate mortgage jumped above 5% last week from just under 3% in November. Rock-bottom rates until now fueled a scorching housing market. The hope is higher rates cool it off. There's another bright spot, savings accounts. For years, the economy rewarded borrowing money, not saving it. Savings accounts will start to earn again, but it could take time. Banks are slower to pass along interest increases to savers than they are charging the higher rates to borrowers. Bottom line, it's a huge shift for consumers who will need to pay down debt to avoid higher costs to carry it.
All right, so there you have it. CNN.
I invest in Invesco Q.
Just this is off of CNN Business, what the Fed rate hike means to you. All right, so we already went through that, but I just wanted to put that in perspective again, what it means. Okay, so that's all I have. I wanted to give you all this update. This is a part of our series, Gateway to a New Economy. Now we're in the phase of what we talked about last year. The predictions that we gave are literally coming true. All right. Okay, fam. So I hope everyone is taking care of themselves. I hope everyone is doing well on this Wednesday. This is Rhonda with WTUZ Radio Podcast. Peace and love, family.